This episode of It's Your Call is one of a series dedicated to facing the mortgage crisis in Southern California, brought to you with the support of the Corporation for Public Broadcasting. Good evening, I'm your host, Roger Bowman. This series has previously asked banks to come in and tell us what they're doing to help homeowners. And tonight, we're pleased to have representatives from two banks in Southern California in studio with me tonight. With me are Larry Sharp, president of Arrowhead Credit Union, and Rod Tawasha, home preservation manager for Chase Bank. Tonight's show is pre-recorded, so we will not be taking any calls this evening. Before we get started with our guests, I'd like to let our viewers know that KVCR has organized a mortgage crisis town hall meeting, and you're invited. Join us on Saturday, August 15th at 1 p.m. at the San Bernardino Library for 90 minutes of interactive discussion with the best of our local regional experts. Go to kvcr.org and click Facing the Mortgage Crisis to learn how to reserve your free seats. Thank you very much for being here, gentlemen.
Thank you for having us.
Thank you.
Let me start because you're with Chase Bank.
Sure.
Rod, may I call you Rod?
Sure.
Okay.
Yeah.
Rod, do you cover just the Chase loans, or do you also cover all the other entities that Chase now owns?
All the other entities. We cover Chase, Washington Mutual, and EMC.
And Washington Mutual is one of the two that were most involved, I think, in the original mortgage crisis subprime market. Is
No
that
doubt.
true with Countrywide?
Yes, they were very aggressive in that aspect of loan lending.
Okay. And do you hail from Chase directly, or I see that you have some affiliation with JP Morgan?
Yeah, part of the same umbrella company. Yeah, we're Chase Bank, but part of the JP Morgan family.
Wonderful.
Yes. Thanks.
And Larry, how about you? May I call you Larry?
Yes, absolutely.
Wonderful. So your role, president of Arrowhead Credit Union. Tell me a little bit about Arrowhead.
Well, Arrowhead was really started originally 60 years ago by the employees of the county of San Bernardino, and we've grown over the years, really serving the two-county region and serving about 161,000 members.
That's great. And Arrowhead does make home loans, do they not?
Oh, absolutely.
So you're involved in this entire decline of property values and the incumbent foreclosures that come with that.
Well, I would say we're involved with the making of mortgages. We've, different than others, we've actually stayed pretty much away from the specialized kinds of mortgages that the subprime and
Option
the other,
A's, for instance.
Option A's and so forth, and we've really stuck pretty much with traditional lending, and I think that's helped us through this process.
So correct me if I'm wrong, just to give our viewers a foundation. What we're talking about when we mention the aggressiveness of Washington Mutual, the old Washington Mutual, and we talk about you're staying away from those specialized loans and the Option A's,
Right.
What we're talking about is those loans that went out to people who perhaps couldn't afford those homes, but through the financial structure of the loan, they could make perhaps interest-only payments for a while and not draw down their principal. They could do other things whereby they had teaser rates, and
Right.
the idea is eventually the home value would go up and perhaps their income earning power would go up and be able to service the loan over the long term.
Well, we're a very different kind of organization in the sense that we're owned by our members, and we pretty much have to make sure that we are looking after our members' interests because we are a financial cooperative owned by our members. So we can't very well be trying to put mortgages over on them that are ones that are going to hurt them financially.
You'll be hard-pressed to find a major lender that didn't write these type of loans, and we're trying to work out the issues associated with those loans currently. Chase has been very aggressive with helping preventing foreclosures to many of the homeowners through the loan modification process. From the last 3 months, we've done 138,000 trial modifications with another 155,000 that's currently in process or under review. As of 2007, we've prevented 565,000 homes from going into foreclosure. So we're very proud of that.
Expand on that, Rod. How do you prevent 500,000 homes from going into foreclosure?
Home preservation, outreach, community outreach, getting in touch with the people that are facing the biggest hardships and letting them know they have a place at Chase that'll help them understand their hardship and try to put them into a loan modification program that'll help them through their financial needs.
And I want to explore that further,
Sure.
a little further down in our show.
Sure.
For now, what I want to do is lay the foundation for basically how we got there. And I know, despite the aggressiveness of the banks and some people who say that the subprime fiasco was really Wall Street and some tinkering, a lot of homeowners potentially benefited. Not everybody who bought a home through some kind of a recent home loan is in trouble. Some people are in homes now that might not otherwise have qualified.
Right.
Yes.
And I know the federal government too, and we've talked about this, because I'm mentioning this largely because the banks have gotten certainly their fair share of rancor and public outrage, but not all of it necessarily is deserved, because the banks made the loans to people who looked at the time, based on the economy of the time, that they may be able, or they probably could certainly pay it. But even more important, I know the federal government was encouraging banks to make loans because we wanted at the time as a national goal to put more people into their own homes, because that was their financial security. That was considered a few years ago to be the best possible investment that anybody could have leading to their retirement.
Right.
I believe it still is, with proper due diligence in doing so. Yeah.
So, Rod, are you saying that, without becoming a prognosticator, are you saying that you think that the housing market will fully recover, and that this will be an unfortunate episode that happened in the late 2000s?
I'm hoping it'll fully recover, and by what Chase is doing in particular about being, again, aggressive with the loan modifications, opening up the Chase homeownership centers across the country, again, with a lot of the foreclosure workshops, outreach events, direct marketing to let borrowers know that they could come to Chase for help. I think that'll hopefully slow down the foreclosure process going through the future. At least we're doing our part in doing so.
Well, Roger, we've seen cycles in the early 80s. We saw cycles in the early 90s. And now again, we see this cycle. This cycle simply sets itself aside by being deeper and longer than the others. But essentially, that is what we've seen in this growth cycle of the Inland Empire. About every 10 to 15 years, we see this cycle going through. Will it recover? Absolutely. And is it a good time to buy a home? It's wonderful for the buyer.
Right.
Who's out there, someone who is qualified and able to buy a home. You can't find a better value today. And you couldn't find a time when you have better prices on the home loans in terms of the interest rates. I mean, we've got historically low rates. We've got historically low property values. And a wonderful time for people who wanted to buy a house to do that at this point. So it depends on which part of the situation you're in. Either you're the homeowner who's hanging on, whose property is undervalued, and it's lost the value. But to them, I say, if you can afford it, hang on to it, because we go through these cycles, and certainly we'll see that happen again as we go through. We've got historically pressures from Orange County and LA because our housing is traditionally lower, and it's not changing. And in fact, it's getting worse right now in terms of the difference between the values of the coastal properties and the inland properties. And so will we see them recover? I think we'll definitely see them recover. The problem is, how do you really stop the cycles over time?
And Larry, you mentioned something that I haven't heard, and we've done this for many weeks, and that is that the decline in the property values of the coastal communities and perhaps the central LA area really drive the decline of the properties of the Inland Empire.
Right.
So what they do affects us.
Absolutely. They drive to a large degree our market. It's that inflow of folks who can't afford a house in Irvine or can't afford a house in LA who are buying homes here, because then that's our commuters going back and forth.
Yeah, I think there will be a recovery to the extent based on where it was before through this last cycle, because of the lending guidelines that were in place. I know Chase is dedicated to responsible lending and to qualified borrowers, and also through a more traditional full package, full documentation underwriting system. So with that, again, I think we'll get the right people, qualified people, into homes. There is money to be lended again to qualified borrowers, and hopefully that'll prevent foreclosures or any type of hardships going forward based on true, actual full package underwriting.
Rod, what you said, though, conflicts with what many people are saying, which is that there's money available. Larry, your point about the homes being at the bottom of the market and a
Right.
great opportunity to buy, everybody recognizes that, but except for a few elite people, most people are saying that, wow, it's hard to get a loan right now. Is that fair to say?
If that person is qualified, it's not hard for them to get a loan.
Full package
We
underwriting.
make a lot of loans today that are very good, but they're standard mortgages. You're not going to do anything that's going to go back to the time when there were all of these different kinds of lending going on. We're not going to do that. It's standard 30-year mortgages that we're doing out there.
Full documentation.
Full documentation. No, phony income statements, if you will.
What is an income statement, Larry?
We've got to see that we've got the paychecks to validate the income, the statements of their tax statements and so forth,
Yep.
to show that what they're saying they're earning, they are earning.
So that's an area that's set up a lot of people for fraud. And I'm not going to point the finger here, but can you tell me, was that more instigated by aggressive banks and lenders, or was that more instigated by aggressive brokers who earned the commission?
I think it has to do with a lot of people involved in the business at the time. I do think that brokers and third parties kind of took advantage of the system. They were able to place their loan. If it didn't work at this lender, they placed it at 20 different other lenders to see who would accept it, based on the information provided. It's hard to place a blame. I think everyone was involved at some aspect, and right now we just need to focus on the recovery.
But there was indeed a period where a couple things were happening. One, there was no income verification, and another was where the income stated was unsupportable.
Right.
And that's what you're saying, obviously, that Arrowhead is not doing now. You're doing the normal due diligence that we saw before the bubble.
As
Well, I
Chase
think
is
you're
also.
seeing that with really most of the institutions, that's the way that you're doing real estate lending today, as contrasted against the prior times. If you go back to 07, 06, that you'll find that the big difference is the diligence that's done in making the loan at this point, and verifying the incomes and making sure that you have a good solid loan.
So the misconception of banks not lending, that's really not the case, is that not as many people are qualifying based on the true traditional full documentation underwriting system.
Okay. Is it also a true corollary, however, that the bar has been raised?
The bar has been raised, and it's been raised to a limit that is reasonable for lending. We had gotten to the point of unreasonableness in the way the loans were being made at that point. You were asking about who was responsible for that. And one of the things that was happening, there were a lot of people who were responsible, whether you're talking about the institutions, the brokers, the folks that are packaging these into the secondary markets, the people who are buying, the people who are rating the paper.
Yeah.
You can take it, well, you can go to Congress as well and say, everybody played a part in making the conditions that existed at that point. And even the borrowers, were willing to turn an eye and say, I really can't afford this when it comes to roll over and to get away from the initial terms. They knew they had low rates in the sense that whenever they turned over 5 years from now, as an example, or 3 years down the line, that they knew at that point they were hoping that they would have more income, that they knew that they couldn't do it with what they had at the time.
Or, I hate to say it, but look at cable television out there on some of the channels that have these shows about make a fortune in real estate, flip the home.
Yeah, exactly.
So if you could buy a home at a teaser rate, wait 5 years, and the rate of appreciation and the value of the home was anything like it had been in the prior 5 years, even though you couldn't afford the home when it reset in 3 to 5 years, during that time you've created tens of thousands of dollars in appreciation. You flip it, and you now have a small nest egg.
That's a great point. A lot of people were seeing people investing in these types of homes, taking these option arm rates or what have you, and flipping it and making tons of money. When things are going well, everyone gets excited, and they never see the end. They never see when is this finally going to come to an end. Everyone's short-sighted about how happy they are to make this type of money and income right now. When the bubble finally popped on all this, as did the tech industry prior, when you had stocks worth 10,000 times what it was worth, it finally came to an end. And that's kind of what we're seeing now, and we're trying to kind of filter through all the garbage that we went through and trying to continue making a strong foundation going forward.
My history, I had one of those high-flying .coms during the bubble, and it too collapsed entirely after the bubble burst. I think the definition, my observation of that and this housing bubble, the definition of a bubble is when lay people are willing to become speculators. And that's indeed what flipping a home is you're speculating on the future of the housing market. And over the long term, yes, it's solidly up. But if you're not prepared to take a deep hit, then maybe you shouldn't be speculating. Maybe you should be buying a home that you can afford from the outset.
That's the bottom line. Buy a home that you could afford.
Then, of course, there's the other category of people that could afford the home, and through perhaps one of a couple different circumstances, things change. There's people who have hardships that include sudden disability or some kind of infirmity that prevents them from working, and they're now at a lower income level, or maybe they have a divorce, or an income earner in their family dies. Then there's perhaps now what we're seeing in the recession more commonly, people that are out of work, hopefully a temporary situation, or people, and I've heard this, who have to move to get a job because the job market's less, it forces them to move. What do they do with their home when they move? They can't sell it as readily on the market as they could before.
And those are the type of people that we definitely need to help and try to fit into the guidelines and the modification programs that are available through the President Obama's Making Home Affordable or the internal Chase modification program, as I'm sure Arrowhead has theirs. There is financial hardships that are happening every day, too. It doesn't matter what class that you're in. An income level doesn't matter at all. We're having all levels coming and saying, I got a hardship, this is what happened. I'm not making the money I used to. My rate's adjusted and my payment is here. Disability of children, whatever it is, this is real. And we need to do something to help the customers out, the borrowers, keep their homes, and continue to have that American dream of home ownership.
I mentioned speculation. There's a difference if you buy a home that clearly you cannot afford, hoping that the market will go up before you have to ante up a higher level. And that's a little bit different perhaps than somebody who buys a home in an area that they think will naturally grow and appreciate. And a lot of our viewers out there have come to the conclusion that the banks knew all along that they were creating a precarious situation and they were just swallowing in as many victims. And I have heard from both of you that indeed you had no prescient knowledge, that you indeed were just as caught up as everybody else. Is that true, Larry?
Yeah, absolutely. Yeah. And from our standpoint, we were really trying to respond to the needs of members and in terms of housing at the time. We didn't have any affiliation with the brokers. Our affiliation was with a member. And so they're bringing in a loan that they want to have funded, and that's what we're responding to. So no, we didn't have that. But I think right now, you had mentioned what was happening in the marketplace right now. We're not seeing as much of the ARMs and repricing and the prime loans that we saw in the front end. What we're seeing today is a result primarily of folks that have lost their jobs having to move, people who have lost their jobs and they're here and they're trying to struggle to stay in their home. We've seen people who have had their hours cut, they are on furloughs, and other areas where they've simply had their income cut to the point in this economy that they're having a difficult time making those home payments.
That's a great point, Larry, because we all were under the misconception that it's because they had option arms and then their rates are adjusting now, they can't afford the payment. Right. Many of these people have fixed rate, low rates. and because of a financial hardship due to the economy, loss of job, or something else that came up, they can't afford their payments now. Maybe another family member lost their job. Now it's only a one-income household. There's a lot of different variables in all this. So it isn't that people got into bad type of loan programs and now their rates are adjusting and now they have high payments. It's just real life that is happening. People are losing their jobs, going through hardships, and I'm very proud to be part of a company, as well as Larry, to be part of a company that are out there reaching out to customers to try to help them. Mm-hmm. So,
I think it's fair to say that any bank would come in and say that they're reaching out. Mm-hmm. So what would give you that credibility? And I'll just say from a personal perspective, sure. I know that we've dealt with Chase personally, and at every step, and this is not because you're here, at every step, our interaction with our first holder, which is Chase, has been easy, communicative, straightforward, and amazingly, we get lots of material that are helpful, from your having sent us the list of HUD counselors in our area, to your having sent us information about the Federal Hope for Homeowners program, to your having sent us information about regional centers where we can go in and talk to a representative. Now that's something that neither our second holder nor most of the other viewers that call have experienced. So tell me a little bit about that.
Yeah, Chase, I'm very proud to be part of Chase and their outreach that they're doing to their borrowers and community. We've opened 27 Chase homeownership centers across the country in the most distressed areas. So borrowers going through hardships could walk into any one of these offices, meet face-to-face with an advisor, counselor, go over their hardship, explain the different programs available to them, let them understand the process, the time, the documents that are needed to go through a loan modification. Because the way the process goes, if you're missing a document or two, it's going to be on suspense or hold, and that you might not know about that until a month later. So you just lost a month part of your time there. So you have somebody that's going to be your direct contact throughout your whole process. And what's so great about this is that when you look at somebody face to face into their eyes and you're understanding their hardship, we have tissues that aren't just for the borrowers, but it's for the advisors. Listen to these hardships that these people are going through. They have skin in that game. They want to do everything in their power to try to help that borrower get a modification and save their home. For their family, because of income reasons, whatever the reason is, I feel that this is the best way for us to do outreach, is really be out into the communities, meeting with these people. People can either walk in or make appointments to come in and, again, meet with these advisors, whether it's the Chase, Washington Mutual, or the EMC platform, and we'll be able to, again, do our best to try to help them with a loan modification process. We're also very active in outreach events, foreclosure workshops. We have strong direct mailing campaigns going out to all these borrowers, letting them know that we are available for help. Come to us. We help not just delinquent, but current customers also. That's a big misconception. A lot of current people think, well, what do I have to do? Be late on my mortgage before you guys will help me? Chase helps current customers. We have a private imminent default department, which means current customers. So if you're current, but you foresee a hardship in the future, come on in. We'll look at your situation. We'll see your hardship that is coming up. We'll look to qualify you under the same type of programs, either the President Obama's Making Home Affordable or our internal Chase modification program. So I think, again, we're doing our best foot forward, doing things the right way to really get out to the communities, to let people know that there is help.
I know
just come on in.
Chase has participated a lot in the information programs that have been out there, that have been put on by the community, where you've been there as a participant, where they've had counselors coming in and talking to the individuals who are coming in. And I think it's a really key thing when you're talking about the borrower who is not delinquent, but seeing that they're having a problem on the horizon. It's so very important for them to come and talk to you. They seem to be afraid to come in and admit that they have an issue coming along. But that's the time that they really need to be there. Frankly, once you've gone delinquent, what you can do is so structured. You have so much more flexibility when they're still current. When they become a delinquent loan, and then you get in with the regulatory issues, with troubled debt restructuring and all of that, wrong time, because your options begin to get limited. as an institution. So I would say that for your listeners, that if you're having an issue, if you see an issue on the horizon, don't wait till you're delinquent. Come in, talk about it, see what you can get done. Your circumstances can change. A lot of what we do is looking at folks, as an example, who, again, have had their hours cut. Maybe one in the household's unemployed and the other is still working. Sitting down and looking at it and allowing them to maybe take a lower payment for a period of time, so that to help them through that process. We do that every day, and we can do that easier for people who are not delinquent. It's harder when you get over on the other side again.
You know, Larry, you're making a great point there with the delinquency. Just from my experience, we tend to see more imminent default current customers feeling comfortable enough to come into our offices to discuss what could you do for me than delinquent customers, which is kind of scary. Delinquent customers feel that possibly they're getting collection calls multiple times a day, they're getting FedEx's certified mail saying, we need payment. They're afraid to come into our offices. And so they go and they'll hire a third party paying them money to deal with us when they could come to us for free. So again, like Larry said to all your listeners, if you're delinquent, don't be afraid to come in. We're here to help you.
The idea that you have a facility where people can go in and talk directly to a loan modification specialist is surprising and beneficial, I think, to the community. A lot of people have told us that they would call, and of course when they call the number that's left on the voicemail on their phone, they receive somebody who might not even be in the U.S. that's on the other end of the line. It's typically a collections department that they're paid and incentivized to be very aggressive collecting because that's in the interest of their employment. So they don't know who to go to. The advice that we've had from most of the counselors that have been here is ask for the loss mitigation department. But it's very different, I think, when somebody can actually walk in to a dedicated facility that's there to meet face-to-face with people that are in the correct position to initiate modifications.
Yeah, we definitely have the toll-free numbers still available for people that aren't able to come into one of our Chase Homeownership Centers. But again, having a presence, having a face-to-face, when you're going through such an emotional situation as possible foreclosure, losing your home, going through the hardship that you're going through, you want to look into somebody's eyes and talk face-to-face with somebody to really hope that they understand what you're going through. And when you're on 800 numbers or on the phone, they do have their value, but that connection isn't quite there. And when you call back, you're going to get somebody else on the line for a follow-up. This way, when we have our Chase Homeownership Centers, you have a dedicated counselor advisor to you through the whole process. You have any questions, any concerns, any follow-up, it's that counselor that's dedicated to you through the whole process. You can make an appointment, sit with them, go over your process, the progress of your modification the whole time. So.
One of the points, Roger, that was made earlier was about third parties.
Yeah.
And I just really want to address that because I see people wasting their money. There are trained folks that are out there that work for nonprofits, that counsel and are very capable, or I think more capable of counseling, because they're going to do more to look after the best interest of that individual, not how much money that third party is going to make off of this client. That those third parties and the nonprofits are well trained and they can help them and give them advice. And there are plenty of them around. You can get to some of the federally sponsored programs. The Inland Empire Economic Recovery Corporation is a good example that puts on many of these workshops, brings in not only folks like Chase, but also the counselors to work with individuals. That's really a great place to really seek advice. Instead of getting with these third parties, they're having problems already financially. why add to the problem more when the advice is out there and it's good, solid advice from a third party who's trained to do this?
I agree, because if they're not going to come directly to the lender, which again we could give them our services for free, there's a lot, like as you mentioned, nonprofit organizations that'll help direct them back to their lender with the right advice necessary. In regards to third parties, I kind of have a little thing that I say, modifications is the new mortgage. That's the new hot thing that everyone's turning into, thinking that's the way to make a quick buck and make some money off people that don't know there are other options. And again, with the outreach of us, what we're doing today, with the outreach events, with the foreclosure workshops, with the direct mailing, we're trying to educate people that are going through these financial hardships that you don't need to do that. Come directly to your lender. We're here to help you, absolutely free.
Well, let me ask about the contrary position, which is the bank is in the position of power in deciding the modification, the terms, the criteria. In all of our other financial transactions in life, we're told to have an advocate on our side, to pay an attorney or to pay an advisor, to come in with knowledge and representation. Why should they suspend it and work directly with the bank?
President Obama's Making Home Affordable program, the guidelines are set. And that's what we're working off of. We accept the program wholeheartedly, and that's the first option we're looking to put every borrower into through the Making Home Affordable program. If they don't qualify for that program, then we also look at the other option, which is the internal Chase modification program.
A lot of people, I think, feel that because the economy went south and a lot of Wall Street and banks were heavily blamed in the media for that, and then all of the bailout money provided to these banks, that somehow they owe a duty to let struggling homeowners simply have their home, forego profit, forego revenue to your banks. Is that a fair viewpoint, or is that a little naive?
I think that's pretty naive. From the banking standpoint, you talked about banks being in a position of power. I don't quite see it that way, because one of the situations that we have is quite simply, we never really want to foreclose on somebody's home.
It's the worst possible
That is
situation.
the worst possible solution to work on. If we can keep that homeowner in the home, if there's a way for us to do that, it is a far better solution. Since when was it ever a better solution to foreclose? It's going to cost us money. It's going to cost us time. It's going to cost us a big piece of that asset that is the collateral in terms of what we get back. And so I would say to you that the people who think that is a solution that we're just waiting around to do need to rethink this whole thing, because we're sitting there going, we really don't want to be in foreclosure.
Yeah, we put all this together, again, with this whole loan modification and outreach that we're doing to try to avoid foreclosure. As Larry says, the worst possible thing that could happen. Unfortunately, not everyone qualifies for a modification due to insufficient income, or perhaps they're looking for us to finance a lifestyle, which we're not in a position to do. We care about them being able to afford their mortgage payment. So unfortunately, there is other options. If they don't qualify for the modification, that's a possible short sale or deed in lieu or what have you. Worst case scenario would be a foreclosure, which is something that we're going to do everything in our power to try to prevent if they fit within a guideline of the options that we have to offer.
Larry, what you were mentioning about is the worst possible outcome. When is it ever a good idea to foreclose? What you're not suggesting, however, is that the other option is just let people sit in their home rent-free.
That doesn't
Or
resolve
mortgage-free.
anything.
Yeah.
You just move the ultimate down the road some. And certainly that really doesn't help us at all either. You really need to have good solutions. If you're a bank and you're doing that, you're putting off the inevitable, and I don't really think that accomplishes anything. Sometimes what you really run into is people who just never qualified for the loan to begin with, or something has happened that make that impossible for them to really pay that loan ultimately. And so in those cases, you grit your teeth and you go to foreclosure. But you make every effort as an institution in the front end to try to come to some agreement with the borrower, in this case, to stay in the house.
One of the functions that we've served, I think, well over the past 8 weeks, now 9 in this series, is we've had some counselors on the show who have told people bad news, but it's news they needed to hear. And some of those viewers that received the bad news were actually grateful because it resolved the ambiguity for them and gave them some clarity. And that is, for instance, and I'll give you an example, a viewer called and said that the person had become single income earner, had become disabled, and it was a permanent disability, and they were qualified to receive disability income, but it meant a permanent reduction of their earning power, and they could no longer afford the mortgage, and they wanted a loan modification that would reduce the interest and the principal so that they could afford to stay in that same home.
Right.
And our counselor basically suggested that if you can't bring your income power back up, then it's unlikely you would ever be able to stay in that home, and you need to look at the ways to process the wind down and what the future will be post-foreclosure for you. And that actually helped because the person then could begin planning. Is that what you find a lot of, where people can't really afford the homes they're in?
And you run into those situations, and very, very similar to that, maybe a little different circumstances. But what you run into is it's not only the house payment, it's how does that person want to live? What kind of quality of life do they want to have? Do you want to stay strapped to a house that you can barely, if anything, afford, and you're eating up every bit of the income? Sooner or later, you're going to be unhappy with the results of that because all of your income is simply strapped to the house or to paying the taxes and the upkeep and all of that. And so I would say there are just sometimes the best business decision for the member or for the customer is just to not continue in the home. And certainly that's something going to counseling and looking at the financial ability to pay and so forth, I think is really important to look at that, because there are times when we really say to the individual, you really don't have what it takes to stay in the house economically, and you really need to think about going through this process.
Yeah,
trying to sell the house.
Yeah.
And many times what we've done is work with them on, just as with people who are trying to move out because they've lost their jobs. I can't tell you the number of times we've done short sales, as an example, for those folks, where we've cut our mortgage down. Realistically, we had to get to the market value for they could sell the house. And that's probably where we most frequently end up doing short sales or on those kind of loans. I mean, they need to get out from under the house. They've got a job somewhere else. And going through foreclosure doesn't make any sense in that situation. And you just have to kind of look at it and evaluate it, cut your losses, and you do take short sale.
Yeah, the first question that our advisors ask is, do you want to stay in your home? They have to be committed that they want to stay in their home. If they're looking to, I just want a lower payment for the short term because I want to leave eventually or what have you, that kind of defeats the purpose of everything that we're doing here. Also, borrowers have to realize the other options they have other than a loan modification. If they don't qualify for a loan modification, it isn't foreclosure. They do have short sale opportunities as an example that they can look into, which is a better option, obviously, than foreclosure.
Rod, describe a short sale for us.
A short sale is that, say, you owe $500,000 and the home's worth $300,000 now, so you're kind of upside down a little bit. You obviously can't sell it at what you owe, so the bank agrees to sell it at a lowered loan amount. Typically, I believe you would get 1099 on the difference, but based on the new Obama plan, I don't think you get 1099 on the difference now anymore. So it's sold at a less of a price than what you owe.
So in that case, the owner relinquishes the home, but they don't have the stigma and the credit hit of a foreclosure on their record.
It's not as bad as a foreclosure, on your credit.
Okay.
So that is definitely a big viable option that not a lot of people think that they have. They think it's either modification or foreclosure. And again, it's more with the education outreach that we're doing to let people know you do have other options. Loan modification is the best scenario if we could try to get you into, but if not, then again, you got to see and project, okay, what am I going to do next? What's my other options?
Earlier, deed in lieu. What is that?
It's not something too common, but it's pretty much where you could assign the title back to the bank and say, here you go. It's something that we're really not looking to do too often. We want to look at the other options to try to keep people into their homes.
And we've seen that, the deed in lieu, as an example for people who have been trying for a long time to sell the house, haven't been able to sell the house. And we've seen that as well, where we've simply taken deed in lieu. We're not doing those frequently, but
exactly.
we do have some of those that we've done as well, and the same practices, really.
So you mentioned earlier about these 27 home preservation centers that you've opened. These are located throughout the United States.
Yes, they are.
And this program of talking about the mortgage crisis is actually a Corporation for Public Broadcasting initiative that's taking place not only in Southern California, but in all the other major cities. Many of our advisors have said that the Inland Empire specifically is one of the hardest hit regions in all of America. Can you attest to that?
No doubt about it. It's documented that it is, and in regards to the homeownership, the Chase homeownership centers, the volume coming through the local Rancho Cucamonga office in the Inland Empire is at least double the production than anywhere else in the country.
Any other city in the country?
That's where the Chase homeownership centers are, yes. So there's definitely a demand. You look at it as great. We're outreaching. We're helping a lot of these individuals going through hardships. And the flip side is unfortunate. A lot of people are having these type of hardships.
Okay, and I'll put you on the spot here, but some of our counselors have said that, frankly, to get through this crisis from a national perspective, that a lot of the banks and institutions are just saying Southern California, especially the Inland Empire, is so hard hit that there's just no way to salvage it. The homes are too upside down. The homeowners have lost too many jobs because of the loss of jobs in the Inland Empire, that we're going to concentrate on modifications for the other parts of the country and just let Inland Empire and Southern California go.
Disagree completely. Haven't heard one thing regarding that. Wherever there's distress and financial hardships, we're doing everything in our power to help those individuals, no matter where you are, where you live, what demographic it is. Absolutely. That kind of thinking has never been whispered or crossed any paths in discussion.
As a regional institution, I hear that in my I just get really upset because Inland Empire economy is, yes, it is the eye of the storm, but it is coming back. I think if you look at the volume of housing sales, of resales of existing homes, that what we found is that, first of all, the price has gotten down low enough that the value is so good that essentially it pushes the sale of homes. And I think it's going to continue to do that. And that supply over time is going to get used up. We're also at a point where when unemployment, as an example, yes, it's still increasing out there, but the rate at which it's increasing has slowed down substantially. The other thing is we've looked at our overall delinquency in the region, from our portfolios, and I think we were down from January to now about 10 million in terms of decline in delinquency. So what we're seeing is that that's starting to turn around. I'm not sure that it's bottomed out totally, but we do expect that we're going to see into next year, improvements in the economy in the Inland Empire. And there are a lot of things that are happening that I think can help that out. And I think we need to concentrate on what we can do. Everybody's focused on stimulus. And frankly, I think we need, from the Inland Empire perspective, to focus on what we can do on a local basis to really stimulate our own economy.
Yeah, I want to make a point here. We're talking about the Inland Empire, how it's decreasing in value. We keep on talking about that, but we weren't talking about during the boom, the Inland Empire was appreciating at an unprecedented rate, higher than anywhere else in the country for 6, 7, 8 years running. So at the same time, what goes up obviously comes down. What goes up hard comes down hard, and that's what we're getting hit too.
And I was taken in by that. Yeah. I was lured into buying at the very top of the bubble.
As I was.
And you were as well,
yes,
were you
I was,
not?
Yes.
And I was as well.
So both of you bought homes at the top of the bubble and have seen them go down substantially.
Yeah.
So you weren't in some kind of a crystal ball position to know that this was coming, and you were just going to take advantage of it through predatory lending.
There's a ton of opportunity here in the Inland Empire. Again, parts of the Inland Empire was being dubbed as the new Orange County. New homes, developments, beautiful homes that you couldn't even think about buying in Orange County for the prices you're buying here. Companies from Orange County were moving to the Inland Empire because the leases were cheaper, better buildings, new buildings, and just growing at a fastest pace. Obviously, again, just like anywhere else, it was growing and moving, and maybe overdevelopment at the time because there was a lot of land available to build. But when the bubble popped, people were left hanging. And again, maybe we're getting hit a little bit more here because the growth was happening much more here in the Inland Empire than it was in the Orange County or the LA County, which has already been developed and thriving. So again, as what goes up comes down, but there's a lot of room for growth once again. So I'm very excited about the future of the Inland Empire.
Yep.
Yeah.
I am too, and there are some programs that have been out there that I think are interesting when we talk about stimulus locally. AB 811 put together a program that's essentially a green program. As you know, the cities are having to really reach carbon footprint goals, reductions. The county is as well because of AB 32. And they've devised, and the first one of these programs was done out at Palm Desert. And after the legislature passed the bill, but allowed the city essentially to make loans to homeowners within the city to do improvements that would push down their energy consumption. And those loans actually were made directly to the individual. They end up on the property. They and get paid through the property tax. They don't get paid conventionally. They get paid once or twice a year when you do your property tax, and you pay that to fund the repayment on that. Those loans that the cities, and I think Yucaipa just approved a program. There have been some other cities. I know in Riverside County, WRCOG is working on a program, and we've got some meetings with SBA next week out to talk about some of this as well, and how some of the SBA programs can fit into this. But getting those kind of programs to where you can do the work. Who's gotten hit the hardest? It's been the building trades.
Right.
Well, of course, then we're getting building trade folks back to work. Who else has been hit hard? The building materials industry has been hit second. So you've got both of those now being stimulated through these kinds of programs. And it hasn't been from a lack. You talk to folks at Palm Desert, they're in their third tranche of doing this. And others are, just starting out. And those programs are not only good for us from an energy consumption and green program, but they're good for the individual because they can cut their operating costs of the house for their energy, and at the same time it's tax deductible because they can pay for it through their property tax,
And it's putting people in the Inland Empire back to work.
And it's putting people in the Inland Empire back to work. And is one of the things that, from a stimulus standpoint, we've been trying to work with the county, try to work with the WRCOG and other groups, Sandbag here, to try to stimulate regional programs of doing this, which would help us faster to get out of where we're at. And it's not something we're looking for Washington to do. It's our own bootstrap of trying to create stimulus in our region.
So stimulate Inland Empire from within the Inland Empire.
Right.
Grassroots.
Rod, I want to ask you, address something, one of these other theories that are out there, that the modifications that are being offered by banks, especially the main banks, are token amounts that they know are unviable, but it at least lets you report to the feds that you're doing something.
Well, when I say token amounts, I don't think that we're just giving modifications just to give modifications. Again, we're working through the President Obama's Making Home Affordable, which there are specific guidelines in place that we need to hit. One of the guidelines is a 31% front-end housing ratio. So based on those ratios, that's what we're trying to modify somebody down to. So their payment is no more than 31% of what their total income is. So being able just to give a token modification, that's not the way it works. When you're working with the government programs, we're going exactly by the guidelines, modifying people down to that 31%. If they qualify, FICO score has nothing to do with it. It's based on pretty much your financial hardship, your expenses, your income, your reserves. That's pretty much what we look at to kind of build that picture and work within the guidelines through the Making Home Affordable program to get people modified and have a more affordable payment. If we get them down to that 31% housing payment and they say they still can't afford that payment, what that tells us is that, again, they have additional expenses that perhaps shouldn't possibly be there or that they need at that point.
And what do you tell them at that point if they have those extra expenses?
Again, Chase, and I think Larry kind of alluded to that, it's naive to think that a bank isn't a business. We care that the mortgage payment is going to get paid. That's what we care about. Do you want to commit to living in your home? Or do you care about that boat that you have or that motorcycle or that timeshare and all those kind of other expenses? We look at your bank statements and you're having a financial hardship, but you went out to eat to restaurants 12 times this month. You got to kind of make a decision of what you want to do going forward. It's kind of like help us help you. And if we get you to where you need to be, then you got to do the rest for yourself.
That kind of counseling is actually something that the Springboard advisors were talking about, because they do HUD counseling for home ownership preservation, but they also do credit counseling, and they're affiliated with the credit.org website. So thereby they've mentioned that on this show, a lot of people come and they have their gym memberships and they have their timeshares and they have their quads and their other toys still when they're trying to get these modifications.
Yeah. Again, we're not going to finance a lifestyle, unfortunately. We really want to really go after people that are going through true hardships based on normal living expenses.
What about the oft-heard desire to get the principal reduced? We've not seen that actually happen very much. And what are the obstacles to doing it? Because I presume that if you short sale or if you foreclose and then sell at auction, the amount that you're going to receive from that is, in essence, a principal reduction.
Yeah. Larry, do you want to talk on that? There's a couple of different theories on it. Yeah.
Well, we're again in short sales and everything that we're doing really looks at the whole situation, where the person's at. I think it has to be responsive to that. We have people who come in and just want the balance reduced. And they can afford the home.
They just want the gift of...
They just want the gift of reducing it. Someone down the street bought the house for $200,000 less, and they think that they ought to have a reduction as well. And our answer to that, frankly, is no. We're not going to do that. No. We will help people who need help. One of the things that is ironic about this, in the human natures there obviously says reduce mine,
and Larry,
because I know it's going back up.
I'm going to confine you to about 30 seconds. I'm sorry, we're already at the end of our program.
But again, we have people who want that. reduction who just really are looking for a gift? And the answer is no. Because when we come, if we give it to them and a year or 2 years later, the home is well overpriced what it originally was when we made the reduction,
they're not going to give it back.
they're not going to give it back.
Yeah. All right.
So why should we give away our shareholders' money?
Larry, I'm going to close there. Rod, I'm sorry I don't have any more time.
No problem.
I'd like to thank our guests, Larry and Rod, for joining us this evening, and thank you to the viewers for watching. If you'd like more information about tonight's show or to reserve your free seats for the August 15th Town Hall meeting, go to kvcr.org and click on Facing the Mortgage Crisis. Please join us next week when we'll be joined by Dr. John Husing, the top economist in Southern California, and Bob Hooker from the Inland Empire Economic Recovery Corporation. I'm Roger Bowman, and remember, it's your call.
For more information about this project and related topics, visit kvcr.org and click on Facing the Mortgage Crisis.